Okay. Going back to this, what I was trying to tell you is that you can come at this two different ways. You can come at it figuring out the excess. Well, you can figure out the tax owed, gift tax owed, using the unified credit and figuring out the excess taxable gift. But you can also figure this out by determining the excess exemption equivalent and multiplying that excess times the flat rate of 40%. And this first part, that's what they do. They use the unused unified credit, and even after that, and they deduct that and the current tax on prior taxable gifts from the, I guess what you would call the tentative tax of $3,145,800, and the excess is $1,028,000. I mean, you can come at it by figuring out that 8 million minus 45.43 million, the excess there over the exemption equivalent is 2.57 million, and you simply take that excess and multiply by 40%. Either way, you come to the answer of $1,028,000. I think that's what I was trying to point out. So anyway, the federal estate tax, remember this is a unified tax, and we'll integrate all this so that you understand where the gift tax fits into the calculation for estate tax owed, if it's owed. And so let's talk about a couple of concepts that come into play when you're talking about the gross estate. First, there's this process of probate. Probate courts are state courts, and each county has a probate court. It may not be called a probate court. In larger counties, they actually have courts that are called probate courts because there's so many deaths. Thus, there's so many probate cases to adjudicate. In smaller counties, usually like the county court or some equivalent to that is assigned to hear probate cases. But simply, probate is the process of paying the debts of the decedent, the person who has died, and transferring the ownership of any remaining property. It says here to the decedent's heirs. That's not exactly correct, so let me make sure you understand. If the decedent dies and leaves a valid will, usually that will is going to name certain beneficiaries of designated beneficiaries of what the decedent wants those beneficiaries to have of his or her property. And so if that's the case, they're called beneficiaries. Now, if the decedent dies without a valid will, then each state has these things called laws of intestacy, and so they die testate, And the laws of intestacy, in the absence of will, tell the parties what property each will take and what percentage each will take. So, just so you understand, I'm being a stickler here, but it's kind of important to know when you're talking with clients, colleagues, bosses, these terms, because they're different things. Now, the probate estate is property owned by the decedent in the name of the decedent at the time of death. Now, the probate estate is not the same as this thing, gross estate. Okay? Gross estate is a broader term. The reason it's broader is because the probate estate does not include things that automatically transfer at the decedent's death. And so, some examples of property that transfers automatically at the decedent's death are things like joint accounts with right of survivorship. You see that often with bank accounts. Another example is insurance, life insurance, that is on the life of the decedent, and the beneficiary is a named party other than the decedent's estate. That life insurance passes outside the probate estate and goes directly to that beneficiary, named beneficiary. Okay? So, those things, bank accounts of the decedent that are joint with right of survivorship, and life insurance proceeds on the decedent's life that went to a named beneficiary other than the decedent's estate, are part of the gross estate, and there are other things as well that we'll talk about, but they're not part of the probate estate. Okay, so gross estate is usually broader than the probate estate. And so we'll talk about some other things that are included in the gross estate here in a minute, but just to give you the formula, gross estate minus expenses, debts, and losses. It costs money to administer the estate of the decedent. It costs money to do things like sell property, pay expenses, pay debts of the decedent at the time of death. Equals the adjusted gross estate. From the adjusted gross estate, you subtract marital and charitable deductions, and that equals the decedent's taxable estate. From that, you add the adjusted taxable gifts, something that was done when you were calculating gift tax, equals the estate tax base, and then you multiply the estate tax base times the current tax rates, and that is your tentative tax. And then from the tentative tax you deduct gift taxes paid on adjusted taxable gifts. You also deduct any unused unified credit. and that is your estate tax payable. All right, so anyway, back to this. The gross estate consists of the probate estate plus the value of certain automatic property transfers that take effect at death. And again, joint ownership is another thing. Let's say you own property jointly with another person. Half that property would be yours in your probate estate. How do we value this property? Well, again, it's back to fair market value. You have a couple of different options here. You meaning the executor or the administrator. The person who finds the assets of the decedent and collects them for the benefit of either the heirs or beneficiaries. If there's a will, this person pays the debts and distributes the property, of course. That person, if there is a will involved, is called the executor. If there's no will, that person's called an administrator. Basically, their job is the same. It's kind of like a trustee. When they were talking about trusts, this executor or administrator has a fiduciary duty to the beneficiaries or heirs, and their job is to collect assets of the decedent, pay the debts, and distribute the property accordingly, in line with the decedent's wishes or per the laws of intestacy if there's no will. Okay, so back to this. Property is valued at the fair market value at the time of the death, but if the executor elects, they can value the estate at an alternate date, which is 6 months after the date of death, but only if it reduces the gross estate and estate tax of the decedent. If it's going to increase the estate tax, of course, that person would be an idiot to make that election anyway if it increases the gross estate and the estate tax. So it kind of makes sense that you'd only pick that alternative valuation date if it reduces the gross estate and estate tax. And again, these automatic transfers include property owned by the decedent in joint tenancy with right of survivorship, proceeds of life insurance paid due to the death, if either one of two conditions is met. The decedent owned the policy, or the decedent's estate or executor is the beneficiary of the insurance policy. And a good planning strategy here is if the decedent doesn't want the face value of the life insurance policy included in their gross estate, what they would do is have someone else, let's say children, be the owner of the policy. And then they could also be named the beneficiary of the policy. So that would be a way of getting it out of the decedent's estate. So that's a good estate planning tool. Well, what if the decedent owns the life insurance policy? Can they transfer this policy to his children or her children and get it out of their estate? The answer is yes, but this next thing might prohibit that, and so that next thing is this transfer within 3 years of death. If you transfer property within 3 years of death, I guess Congress thinks that you're transferring this property in anticipation of your death, so it really has nothing to do with whether or not you are anticipating your death. I mean, you could not be anticipating your death and just die all of a sudden, even though you're in good health. You know, it may, as you know, things happen. So, but if it's that, they don't look at that. If you transfer property within 3 years of death, it's brought back into the gross estate. And if there was any gift tax paid on that transfer, that lifetime transfer, then the gift tax is added back in. And so it's what they call grossed up for the amount of the gift taxes paid, if any. And so this just kind of gives you some detail depending on the type of ownership form, the amount, and based upon your marital status, the marital status of the co-owners, the amount that you have to bring back into the gross estate. And again, all they're doing is following the formula that you saw in Exhibit 25-6. And so once you've figured out the gross estate, you reduce it by any administrative expenses, debts, losses, and, if any, state death taxes. Okay, so that's not a real biggie. That's just kind of there. The one that we want to talk about is the marital. Well, let's talk about the charitable deduction. As you know, in gift tax, there's an unlimited charitable deduction. The same is true for testamentary charitable gifts. So, unlimited charitable deductions at the date of death to any beneficiary this would have to be a named beneficiary, right? So there's got to be a will involved here. A charitable organization is never going to be an heir. These are your close family members, usually. So this has to be per a will, and the will, the decedent, who is the testator, the person making the will, names the charitable organization as a beneficiary upon their estate, or a portion of their estate upon the testator's death. So that's a really powerful deduction. You don't want to leave property to your kids. You think that it's just going to stunt them personally and professionally. Make the beneficiary a charitable organization. Or what you could do is you could set up a testamentary trust and leave property in the trust for the benefit of their children for a certain amount of time or for their lifetime, and then name the charitable organization the beneficiary of the remainder of the corpus. So, I mean, there's a couple of, well, at least I mentioned 2 options. There are others, but there are 2. There's 2. The marital deduction is essentially unlimited. And again, obviously you have to be married in order to achieve this marital deduction. And so essentially when you are married, since there is an unlimited marital deduction, essentially what happens is that the property involved in the first to die's estate moves to the surviving spouse and is included in the surviving spouse's estate, not the decedent's estate. Okay? And so it's a last to die sort of thing. Not only that, but if the first to die doesn't, well, to the extent they don't use up their exemption equivalent of 5.43 million, let's say they don't use any, then the surviving spouse gets to use any unused exemption equivalent that the decedent didn't use. So let's say the decedent didn't use any of the exemption equivalent of 5.43 million. Then in that case, the surviving spouse upon their death gets to use not 5.43 million, their exemption. They get to use their exemption plus the decedent's, the first decedent's unused exemption of 5.43. So 10 million point 86, 10,860,000. So, you know, again, there's a lot of estate that can pass before there's any estate tax due. Now again, in the computation of estate tax, you have to add back in adjusted taxable gifts. These are prior gifts. They're not already included in the gross estate. Well, where would that be? Well, those would be prior gifts made within 3 years of death, right? So it would be prior gifts beyond those 3 years before death. And the objective here is to allow the estate tax base to reflect all transfers, both lifetime and at death. That's why it's a unified tax system, transfer tax. Again, back to this unified credit. I mean, all you have to do is take the exemption equivalent. Let's say surviving spouse has their 5.43 and also their spouse who is dead didn't use any of theirs. So the exemption equivalent is 10.86 million. you'd simply take that number and multiply by 40% to figure out your unified credit. And so again, the point of the unified credit is that it eliminates transfer taxes on estates with minimal lifetime and testamentary transfers. It's measured by the current tax on the exemption equivalent. You should already know that. The credit is applied after reducing the total tax on cumulative transfers for taxes payable on adjusted taxable gifts. You know that too. And again, this unused credit of the deceased spouse is called deceased spousal unused exclusion, or DSUE. This is something that's fairly new. I think Congress passed this in 2010. Notice how the annual exclusion has gone up quite a bit. Congress has tried to, although how successfully we don't know, but tried to exempt a lot of small estates from gift and estate tax. But, I mean, in certain situations, 5.43 million may not be enough. Can you think of some situations where, and again, it's based upon fair market value, right? Because you base these gifts and testamentary property transfers on fair market value, do you think that the frequency of gift and estate tax returns being audited are high or low? And the answer is they're high. There's a lot of audits of gift and estate tax returns because of the possibility for, I don't want to say mischief necessarily, but I mean, fair market value can be very subjective, and you know, the IRS wants to make sure that the taxpayers involved here are being truthful. And, you know, maybe it's not even that the taxpayer is trying to deceive the IRS. Maybe they just have a different opinion as to what the value is. Usually, that opinion is lower than what the IRS might claim the value is. So you get into a lot of this, you get into a lot of litigation involving valuation. Anyway, back to my question, can you think of instances where the 5.43 million might not be enough? Because again, these transfers are based upon fair market value. And I can think of two, and at least probably in this part of the country, one of them may be quite relevant, and that's the family farm. You know, family farms are usually, not always, but usually land rich and cash poor. And if you have thousands of acres that you own, and you have to value this at fair market value at the time of death, usually they're going to require you to value it at highest and best use, and that may require a valuation that's much higher than what you thought it was. Well, you know, again, if you've got 1,000 or 2 acres on your hands, you got a lot of land, but you may not have a lot of cash to pay the estate tax. And so you see a lot of family farms getting into a situation where because of the valuation problem, they exceed the exemption equivalent of 5.43 million, or whatever the number is in the year applied. And so what do the beneficiaries or heirs have to do, because they're the ones saddled with, I mean, if you think about it, really the executor or administrator kind of is, but it really ultimately falls on the beneficiaries or heirs, because if there's lots of land that passes to them but not lots of money to pay the estate taxes, what do they have to do? Well, they're going to have to sell part or all the land just to pay the 40% estate tax. So before you think that you know, this is great because it sticks it to the rich, that's not always true. There's a lot of family farmers that get caught up in this. There's a lot of small to medium-sized business owners that get caught up in this. And they end up having to sell part or all of the business to pay the estate taxes. That just seems unfair to me, because they were already taxed once. How were they taxed? Well, income tax. So it seems sad to me that we even have an estate and gift tax. Not a big fan, as you can tell. All right, so here's an example. Ed died this year with a taxable estate of $10 million. I guess Ed is single. He made a $1 million gift that was offset by the unified credit. What is the amount of estate tax due on Ed's estate? So the tax on cumulative transfers, which is the 10 plus 1 million, is 11 million times 40%, right? Well, it's going to be, well, actually 10 million times 40%, and then the 1 million is taxed at 345,800. So that's where you get the 4,345,800. And so from that, you deduct the unified credit of 2,117,800. And so the tax due is 2,228,000. Of course, you could come at this using the excess over the exemption equivalent of 5.57 million and multiplying that times 40%. I actually think that's easier to do. But either way, you come up with the same amount. All right, let's talk about some wealth planning tools, strategies. The big one is a strategy of serial giving. Now, this doesn't mean like, giving Fruit Loops. This is about giving over several years to several donees, okay? It's repeat giving throughout the years. And so remember, you have an exclusion, yearly exclusion per donee of $14,000, at least in year 2015. It may go up. So, again, back to my example yesterday. You've got 5 children and 10 grandchildren. You can shelter, you can get out of your estate that amount of property. 14 times 15, $200,000 a year. So you can give a lot away before you die. And you can give a lot during your lifetime without being subject to gift tax because of the annual exclusion per donee. The other thing is charitable contributions. Either during your lifetime or at death. Unlimited. So you can give your estate for a good cause. Now, remember this deceased spouse unused exclusion has kind of done away with a strategy that a lot of tax planners used to use called the bypass trust. Used to, what you would do before this DSUE was enacted was you would, upon the death of the decedent, transfer the decedent's property to a testamentary trust. And this trust would have provisions that allowed for the trustee of the trust to pay income from the corpus of the trust to the surviving spouse. And upon the surviving spouse's death, the property in the trust, the corpus, would transfer usually to children and grandchildren. So that was how you used to be able to get property passing to others and not being in the last to die's estate, reducing their estate tax. Well, now you don't have to do that because of this DSUE. Back to serial gifts. Remember that you have to value this stuff at the time of either the gift or date of death, depending on whether it's an inter vivos gift or a testamentary gift or testamentary transfer. Because it's valued, this property that's given is valued at the time of the gift or death, what type of property would you want to give in this serial gift strategy during your lifetime? Well, you would want to give property that's at a low value at the time of the gift, but that you expect to increase in value in the future. Therefore, you want to get it out of your estate by gifting at a low fair market value so that it's not in your estate at the time of your death at a high fair market value. So that's another strategy that estate planners often take. All right, so that's it for gift and estate tax. Hope you learned something from it. It's, I think, kind of a neat part of taxation. All right, next time we're going to talk about Chapter 2 and get into tax research and writing a tax memorandum.